Welcome back to the Deep Dive. Today, we are plunging headfirst into, well, an asset class that's really shaken things up, cryptocurrency.
It definitely has. It's not just for tech geeks anymore, is it?
Not at all. It's gone from this sort of niche curiosity to a massive multi-trillion-dollar global market.
Right. And for you, listening, getting your head around Bitcoin and Ethereum basics is important, sure. But the real mission today, I think, is understanding the latest U.S. regulatory shifts. That's what's shaping things right now, here in November 2025.
Exactly. That's our focus. We want to give you a clear picture of the tech itself, how it works, and then zoom out to what's happening legally, legislatively, because that's defining the next chapter.
We'll break down the fundamentals, look at the current market, and then really unpack the impact of things like the Genius Act.
Okay, let's do it. Let's unpack this.
Right.
So starting right at the beginning, cryptocurrency. We would say it's digital money secured by cryptography. But the big idea, the real jump, is decentralization. What does that actually mean compared to, say, the U.S. dollar?
It's a fundamental difference. It means taking out the middleman, the U.S. dollar. It's totally centralized. The Federal Reserve controls it, banks manage it, the FDIC insures it.
Okay.
Cryptocurrency aims to be decentralized. So no single bank, no government, no one company is in charge of the ledger.
So instead of transactions going through a bank's central server, it's direct, peer-to-peer, P2P.
Exactly, peer-to-peer. And the security, the trust that a bank normally provides, that comes from the cryptography, the complex math.
So the math secures the transaction and even controls how many new coins are made.
Precisely. It makes counterfeiting incredibly difficult. So the key takeaway is crypto is digital, it's decentralized, uses heavy math for security, and lives on this open public ledger, not hidden away on a private bank server.
Okay, that public ledger. That brings us neatly to the engine powering all this blockchain. You hear that term constantly.
Right, and it's the core technology. It's a type of distributed ledger technology, or DLT. It's what makes decentralization actually work in practice.
So if crypto is the car, blockchain is the engine.
That's a good way to put it, yeah. It validates and records everything.
How does it work then? This idea of transactions getting bundled into a block.
Well, a block is just what it sounds like, a bundle of recent confirmed transactions. The network, all these computers participating, they verify this block.
Verify how?
Using cryptographic techniques. They check that everyone sending crypto actually has it to send. This solves the old double spending problem, trying to spend the same digital money twice.
Right, which was a huge hurdle for early digital cash ideas.
The massive one.
And once that block is verified, it's locked in, immutable. That sounds like the core security feature.
It is the revolutionary part. Once it's validated, the block gets this unique digital code, like a fingerprint. It's called a hash, and it's mathematically linked to the block that came just before it, forming a chain.
Okay, the chain.
And altering anything in an old block, it's practically impossible. You'd have to change that block, recalculate its hash, then change the next block because its link is now broken, recalculate its hash, and so on, all the way to the present.
And you'd have to do that on thousands of computers hosting the ledger simultaneously.
Exactly. The computing power needed is just astronomical. It's computationally infeasible, tamper-proof, essentially, without needing a central authority to guarantee it.
Incredible. Okay, let's get practical. To use crypto, I need a digital wallet. And that holds two keys.
Yes, your public key, think of that like your bank account number. You share it freely to receive crypto.
Okay.
But the private key, that's the crucial one. That's your digital signature. It's what authorizes sending crypto from your wallet.
So if that private key is literally the only thing protecting my funds, aren't we just swapping bank security for something potentially more dangerous? Total personal responsibility.
You've hit on the philosophical core right there. With crypto, you are your own bank. You get the freedom, the permissionless access, but you shoulder 100% of the risk. Lose that private key.
Gone.
It's gone forever. There's no password reset, no helpline, no FDIC insurance. It's just gone. That level of self-sovereignty is something most people aren't used to in finance.
Definitely a critical point. So, okay, I use my private key, sign a transaction, broadcast it. The network then needs to agree it's valid. This is consensus.
Yes, consensus mechanisms. It's how all those distributed computers agree on the state of a ledger without trusting each other individually. It establishes trust in a trustless environment.
And the main ways they do this are proof of work and proof of stake.
Those are the two big ones, yeah. POW and PAL-S.
Proof of work, POW. That's Bitcoin's method. We hear it's super secure but uses a ton of energy.
It does. POW is all about computational power. Miners use specialized computers to race, basically, solving these incredibly complex math puzzles.
Why?
The first one to solve the puzzle gets to add the next block of transactions to the chain and earns a reward in new Bitcoin. The security comes from the sheer cost financially and energetically of trying to cheat. To attack the network, you'd need control of more than half the computing power, a 51% attack, which is prohibitively expensive.
So the philosophy is security is worth the energy cost.
For Bitcoin, yes, that's the trade-off it made.
Then there's proof of stake, POS. Ethereum uses this now,
Right.
along with many newer cryptos. How does that work?
POS changes the game. Instead of computational power, it relies on financial incentive. Users, called validators here, lock up or stake their own crypto as collateral.
Okay, so they have skin in the game.
Exactly. The network randomly chooses a validator to propose the next block. If they act honestly, they get rewarded. If they try to cheat the system,
What happens?
the network automatically penalizes them by slashing, taking away some or all of their staked coins. So security comes from the financial risk, not energy burn. It's vastly more energy efficient and generally faster, too.
Interesting. Different approaches to achieve the same goal. Distributed trust. Okay, we understand the tech, how it's secured. How does the government, specifically the U.S. government, view this asset? Taxes, for instance.
Right. For anyone listening in the U.S., this is key. The IRS treats cryptocurrency as property, not currency.
Property, like stocks or real estate.
Precisely. So every time you sell crypto for dollars, trade one crypto for another, or even use crypto to buy something like a coffee, that creates a taxable event.
Wow, okay. So you need to track your cost basis and pay capital gains tax.
You do. It adds a layer of complexity for sure.
Let's talk investment. What are the big narratives driving the market? Why Bitcoin versus Ethereum, for example?
They serve very different purposes, fundamentally. Bitcoin is often called digital gold.
A store of value.
Exactly. A potential hedge against inflation, maybe. Its value proposition rests on its decentralization and, critically, its scarcity. There will only ever be 21 million Bitcoin, period.
Finite supply. Okay. And Ethereum.
Ethereum is positioned as the world computer. It's not just about sending value, it's a platform. It's built for running decentralized applications, dApps, and complex digital agreements called smart contracts. Think of it as programmable money.
And everything else. The thousands of other coins. Altcoins.
Generally, yes. Altcoins. They usually aim to improve on Bitcoin or Ethereum in some way, maybe faster transactions, more specific use cases like supply chains or integrating new tech like AI. But typically, they come with higher volatility and risk.
Speaking of volatility,
Yeah.
let's bring this right up to date. November 2025. Been a bit choppy lately, hasn't it? We saw Bitcoin dip back towards that big $100,000 mark.
It was a sharp pullback, yeah. What triggered it seems to be massive liquidations of leveraged positions.
Meaning people borrowing to bet bigger.
Right. Traders using borrowed funds to amplify their bets. When the price dropped unexpectedly, those positions were automatically closed out, liquidated, forcing more selling, which pushed the price down further. It's a cascade effect.
A painful reminder that this is still very much a risk-on asset class.
Absolutely. High beta. And you saw that reflected in the altcoins, too.
They took the biggest hit during that slump, right? What does that signal?
That's a classic risk-off move. When sentiment turns fearful, capital tends to flee from the smaller, potentially less stable altcoins and flow into the perceived safety of Bitcoin, the largest and most liquid crypto asset.
But you mentioned innovation is still happening underneath the surface noise.
Yeah.
AI-driven crypto.
Yes, that's actually a really interesting bright spot analysts are pointing to. Despite the market downturn, projects at the intersection of artificial intelligence and crypto are still attracting attention and development.
What does AI-driven crypto even look like?
Well, think about things like using blockchain to create secure and transparent marketplaces for AI models, or tokenizing computing power needed for AI training, or verifying the ownership and integrity of the massive datasets AI relies on.
So combining two major disruptive technologies.
Exactly. It suggests that even in a rough market, the focus on real-world utility and technological advancement continues. That's a sign of maturity, perhaps.
Okay, so boiling it down for the listener, the key risks remain.
Absolutely. High volatility is the big one. Those 10%, 20% daily swings aren't unusual. Security risks are persistent scams, phishing attacks, and the ever-present danger of losing your private keys.
So the core advice holds true.
Never invest more than you can absolutely afford to lose, and do your homework. Seriously. Due diligence isn't just recommended, it's essential.
Okay. Let's shift gears slightly to something built on this tech. Decentralized finance, or DeFi. This feels like where crypto goes from just being digital money to potentially rebuilding finance itself.
That's the ambition, certainly. DeFi aims to replicate traditional financial services like lending, borrowing, trading, insurance, but without the banks, the brokers, the centralized companies.
How?
Using those smart contracts we mentioned, running on blockchains like Ethereum, these are bits of code that automatically execute the terms of an agreement.
Can you give a concrete example? How would lending work in DeFi?
Sure. Take platforms like Aave or Compound. You could deposit your crypto into a smart contract, essentially using it as collateral. Someone else could then borrow against that pool of collateral. The smart contract handles everything, setting the interest rate based on supply and demand, managing the loan terms, and even automatically liquidating the collateral if its value falls too low to cover the loan. No loan officers, no intermediaries.
Wow. Or trading. Decentralized exchanges, DEXs.
Right. Platforms like Uniswap. They allow you to trade crypto directly from your digital wallet with another person's wallet. The liquidity, the pools of assets needed for trading isn't provided by a central company like Coinbase or Binance, but by other users who deposit their assets into liquidity pools.
And they earn fees for doing that.
Exactly. They earn a share of the trading fees generated by that pool. It's a completely different model.
It sounds incredibly innovative, but also complex. And it seems like it would need some level of stability, ironically. Which brings us to stablecoins.
Perfect transition, because stablecoins are crucial for DeFi, and they've been the focus of major U.S. regulation.
This is the Genius Act we mentioned earlier.
That's the one. Officially, the Guiding and Establishing National Innovation for U.S. Stablecoins Act. Quite a mouthful.
Okay.
It was signed into law earlier this year, 2025, and it created the first real federal framework for regulating stablecoins in the U.S., a landmark piece of legislation.
What was the main thrust? The biggest requirement?
The absolute core is the 100% reserve requirement. It mandates that stablecoin issuers must back every single token they issue, one-to-one, with highly safe, highly liquid assets. Think actual U.S. dollars held in a bank or short-term U.S. Treasury bills.
Why was that so critical?
It's a direct reaction to the failures we saw back in 2022 and 2023 with algorithmic stablecoins or ones that weren't fully backed. Those collapses wiped out billions and shook confidence. This is about consumer protection and preventing that kind of systemic risk.
Makes sense. Did the act address anything else significant?
Yes, a couple of key things. It generally prohibits stablecoins from paying interest or yield directly to holders. The idea is to maintain the traditional separation between banking activities and commercial activities.
So stablecoins aren't supposed to act like interest-bearing bank accounts.
Correct. And maybe most importantly, it provided crucial jurisdictional clarity. The Act states that payment stablecoins regulated under its framework are not considered securities by the SEC.
That's huge. That was a major point of contention for years, right?
A huge point of uncertainty. Getting that clarity from Congress was a massive step.
So with this clarity and these rules, what does it mean practically? How might stablecoins be used now?
It opens the door for much deeper integration into the existing financial plumbing. We're talking about the potential for regulated stablecoins to operate smoothly over traditional payment rails like the Automated Clearinghouse Network, ACH, which handles bank transfers, and maybe even the Fed's newer instant payment system, FedNow.
So using crypto tech for faster, maybe cheaper dollar payments globally.
That's the potential, yes. Making the dollar itself more efficient and accessible using this regulated digital format.
Okay, this leads us to the final big piece of the puzzle. The contrast between this emerging, regulated but still market-driven decentralized system and the idea of a central bank digital currency, a CBDC.
Right. This is the big philosophical and practical divergence. A CBDC would be the government's version, a digital dollar issued and controlled directly by the Federal Reserve. Centralized.
Whereas crypto and regulated stablecoins are fundamentally decentralized or issued by private entities under government rules.
Exactly. And that centralized nature of a CBDC raises a lot of questions for people.
Primarily around privacy and surveillance, I imagine.
That's been the dominant concern, yes. The idea of the government having a direct ledger of every single transaction made with a digital dollar.
Has Congress addressed that?
They have, actually. Reflecting those widespread concerns, Congress passed another important piece of legislation, the CBDC Anti-Surveillance State Act.
What does that do?
It essentially puts the brakes on a retail CBDC, the kind an individual would use. It explicitly prohibits the Federal Reserve from issuing such a CBDC directly to consumers without first getting clear, specific authorization from Congress.
So Congress has put itself in the driver's seat on that decision.
Precisely. It sets up this really interesting choice for the future of digital money in the U.S. Do we go down the path of market-based, privately issued stablecoins operating under strict federal rules like the Genius Act, or do we eventually move towards a government-issued, centralized CBDC?
And for the moment, the legislative action seems to favor keeping the door open for the decentralized, market-driven approach while putting a check on the purely centralized one.
That seems to be the current landscape, yes. It's a fascinating tension between innovation and control, privacy and regulation.
What an incredible journey through the tech, the market, and the regulations. A really comprehensive deep dive. To wrap this up, can we distill the three most critical takeaways for our listeners?
I think so. First, the technology itself, the blockchain, is genuinely revolutionary. It's building a foundation for finance that can operate without central intermediaries. That's profound.
Okay, number one, the tech is transformative.
Second, remember the risk. The recent market volatility is a stark reminder. This is still a nascent, high-risk asset class. Due diligence, understanding what you own, not over-investing those are paramount.
Number two, high risk requires high caution.
Got it. And third, the regulatory picture, at least in the U.S. for stablecoins, is much clearer now thanks to the Genius Act. We have rules focused on consumer protection and reserve requirements, which potentially paves the way for safer, broader adoption.
Number three, regulation is here, providing guardrails, especially for stablecoins. Excellent summary. Now, for that final thought, something for our listeners to chew on after this discussion.
Maybe this. Consider that the real impact of legislation like the Genius Act might go beyond just regulating stablecoins. It could be seen as the first step in fundamentally upgrading the infrastructure of the U.S. dollar itself, grafting it onto these faster, potentially more efficient, borderless digital rails pioneered by crypto.
So we're not just talking about regulating crypto, but potentially transforming the dollar.
We could be witnessing the early stages of the dollar's evolution into a truly digitally native global currency. Whether the final form relies more on private innovation within public rules or eventually shifts towards a centralized model, that transformation seems to be underway. Watching that unfold is the key investment, I think.
A fascinating perspective to end on. Thank you for navigating us through this complex world today.
My pleasure. It's a space that never stops moving.